Good evening. Well, we'll be waiting 2 or 3 minutes for those who are late. Good evening, everyone. How are you assignments? Yes, I saw your draft, but I didn't read it yet. Or maybe I read it. I answered to somebody about their draft, and but I believe not, it wasn't yours. Okay. Let's be starting gradually. Well, today, the last topic for our course will be about private companies. And usually when we had offline classes for this lecture, I invited some guest speaker who could tell about real-time experience of working with investments in private companies, because this is quite a specific topic, and there are many things outside regular valuation methods or formulas. Sometimes it's psychological things, sometimes it's just operational things, and so on. But online classes, it's harder to organize speakers for online classes. Sometimes some people just feel uncomfortable to speak online. So for today, I'll be your guest speaker, and we'll have a real case to discuss in the class. So actually, I'll post it now. I will explain everything later in the lecture, But if you want to have a look to the model we'll be working with today, you can download it here. Second. I'll post it to the chart. So the link is here, and the same link is available on the LMS. But we'll talk about that a bit later. So, what's the difference between a public company and a private company in terms of valuation approaches? Oh, there are many, actually. First, public companies are usually mature companies, companies with long history, big companies. And because of that, they are quite stable and ready to analyze. So it's on average, of course, public companies are different, and private company can be a mature company, very transferable, with a good financial reports. But on average, a public company can be analyzed as something more or less clear and predictable. And a public company, we can analyze value a public company as a set of financial reports. Last time we discussed that there are many things actually behind those financial reports, and we should be very careful about its operations, about its market, about technology, about quality of financial reports. But mainly public companies are analyzed as if they are a set of financial reports. And for private companies, that just doesn't work. Just because they're less mature and they're smaller, and things change more rapidly with smaller companies. With a small company, we can expect that in a year or two, its market, its financial positions will change dramatically. With a public company, this change is usually quite slow, so we have time to capture the value, to get our profits from the operations we can see in its financial reports now. With a private company, it's not the case. Another difference, very important difference, is that managers are the owners of a private company, usually. And that changes a lot for us, because as a result of that, the operations of a private company is a mix, quite a fancy mix sometimes, is a mix of private affairs of its manager and the affairs of the business. So we should be careful about where the company stops and when start the manager of this company. And another thing is that sometimes, just an hour ago, we discussed with a client, we discussed a case where the client, they wanted to buy a company that was a partner for this client. They thought that maybe they need to acquire this business to grow their position in this market. And they said, but you know, we have a problem. This company is owned by a university. So it's impossible to have a deal with university. So we cannot negotiate with them regular merger or acquisition of their subsidiaries. They just don't understand it. And after some talk, we decided that we don't need to buy the company. We will buy just all people from this company because it was a research company. And in any deal with a private company, you should think about the fact that this company owns everything that on its balance sheet, except one small thing: people. You cannot buy people. You cannot any legal entity or any entity cannot own people. And that means that if the managers, key persons in this company, are very important for this business, that means that sometimes, even if you own a company, you actually don't control it, because the managers of the company can just stand up and go, and you will lose the business. So you cannot buy a company without a deal with key personnel of this company. Not always, but for many private businesses, that's the case. When this business is built on intellectual property, and this property is actually it consists of the property, something that's registered, and people who can develop this property, who can use it. So in this case, you should be careful about what you actually buying when you buy shares of the company. Just because people can go out and you will lose the business. And because of that, the valuation process is a bit tricky, because you should think about what role the managers plays in this business. Sometimes they play a very good role, and as I described now, and the business cannot exist without that. And sometimes, and that will be in our case, they play a very bad role, and this business cannot work with them. So you have to remove them from management, otherwise that just won't work. So because of that, because the management has very large influence on the company as owners and as the managers, private businesses often have lower quality and depth of management. Just because if I have a company where I don't know, I have 24 of people working in this company. 5 of them are my relatives, 5 of them are my friends. So we don't manage this business as a business. We manage this business as a party, and that happens a lot with private businesses, with small private businesses. So another problem is the quality of management. The next problem is that private companies are they don't need to disclose their financial results, their performance, as the public companies have. And because of that, the quality of information, the transparency of their financial reports are not the same as for public companies. So you don't always understand what you are valuing. And this is another level of risk, another source of risk for you in your valuation process. And one of the things that drives this lack of transparency is tax avoidance. Many companies, I would say most companies, most private companies, do something to pay less taxes. Sometimes they do that legally. In most cases, actually, in most cases, they do that absolutely legally, but they build structures, the legal structures that are created only to minimize taxes. And that helps them to get more cash from their operations, but that creates a problem for you when you trying to analyze this company. So, and this is another problem. And what's interesting, there is one good thing with private companies. One thing that actually, in many cases, in many businesses, makes private businesses more efficient than public businesses. So in private business, shareholders have a longer term perspective than in a public company. This sounds strange because a big public company that's valued based on, I don't know, 20, 30 years forecast of its performance, the things we did last lectures, we can expect that the management of this company would be focused on long-term success of the company, always. But in fact, that's not the case. In fact, public companies are more focused on their market value. So they do, not always again, but in many cases, they do things focused on raising their market value. They do something that can drive their net profit to higher values, or do something like this, something that makes their financial reports better. And with a private company, if I'm the owner of a company, then and I'm not going to sell this company, the only thing that's important for me is my long-term future cash flows. So in many cases, private companies are more focused on a long-term cash flows rather than current financial reports and valuation based on those reports. So this is an interesting thing, and that's what happens. Another thing, two things that we actually use in valuation directly is, first, shares of private companies are less liquid. We can, if I bought a share of Gazprom or Sberbank, I can sell them tomorrow. Tomorrow morning, I can sell them with the market price, and there's no problem. There's no technical obstacles to do that. But if I bought today a private company, and yesterday I decided I'm going to sell this company, it can take 6 months, a year, sometimes years to sell this company. So they are less liquid. That means that if I feel that things are going bad, I have no chance to quit. I will take all the risks, and I cannot restrict those risks. And because of that, investments in private companies are riskier than in a public company. And another thing that's important for a private company is the concentration of control. And sometimes it's a good thing, and sometimes it's a bad thing. In a public company, I can expect that the management of the company will work in the interests of all shareholders, because those shareholders is I don't know, faceless mass. They don't have any specific I don't know, requirements, ideas about how to do business of this company. So there's no major shareholder who actually rules. And with the sometimes there is, but even in this case, this major shareholder has a lot of barriers to do whatever they want. But in a private company, the major shareholder can work in their own interests. And that means that, for example, if I have 10% of a private company, and I believe that, and maybe all other shareholders except the major shareholder, if we believe that the company has a good opportunity on some market, and this company actually has this opportunity, but for the major shareholder, it's somehow not beneficial if this company will go to this market. Maybe because this shareholder has another business, and this another business works on the same market, so they don't want unnecessary competition for them. But for our company, that would be beneficial, but we cannot do that. Or maybe this major shareholder has a project in mind, and this project is somehow good for the shareholder, but generally not good for the company. And we, as a minority shareholders, we will be hurt by this project, by this decision, but we cannot stop it. So this concentration of control, the fact that in almost all private companies, there are major shareholders, again, can be the problem for those who have minority share, and it can be a benefit for the major shareholder. So depending on the share we're buying, the valuation will be different. If I buy 100% of the company, I can do anything I want with this business, and the value of that will be higher for me. And if I buy 5% in this business, I can feel vulnerable because the major partner can make decisions that won't be beneficial for me as a minority shareholder. Okay, another thing is that a public company, we usually do valuation for public companies just because of one reason, because we want to buy or sell or do something else with its shares. And the final result of our work is usually a share price. But for private companies, possible reasons for valuation are more diverse. First, maybe we're going to organize some transaction with this company, and this transaction can be private financing for its growth or projects of this company. We can prepare this company for IPO. Maybe we're going to acquire the company. Maybe we feel that this company is going bankrupt, and we're going to value the remains of the company. And maybe we have negotiation with the managers of the company, and we would like to pay them with options or shares. And for that, we need to value those shares. So for any transaction, another possible group of reasons is compliance. In financial reporting, if we hold a subsidiary, or if we have some other reasons to value the company in our financial report, we can do valuation for financial reporting, and we can do the same for tax reporting. This is generally the same as financial reporting, just a set of standards is different. And the last one is some litigation. If we go into court for trial about damages or lost profits or shareholders disputes, in this litigation process, sometimes we need evaluation for this company. So because of that, we will do valuation. And with those different reasons to value the company, the definition of this value will be different as well. For tax reporting, for example, we usually use the term fair market value. For real estate, we use the term market value. In financial reports or litigation, we use the term fair value. In mergers and acquisitions, we can use the term investment value, and that's because the investment value can be very different depending on who is the owner of the company and how this owner can use this company. And you will see in our case that the difference can be huge. And for regular investment analysis, just like with a public company, we use the term intrinsic value. This is just regular valuation that we do. Okay, for this several kinds of valuation, what are the difference between a public company and a private company? The basic rules and methods, of course, are the same. Just like with a public company, we can use free cash flow valuation, we can use relative valuation, sometimes we can use other types of valuation, but there are differences, and mainly those differences are related to parameters. And the first parameter is the market value. In our public company valuations, we used market value of equity to calculate WACC, and we use value of debt for this company. For those companies, we expected that the value of debt reported on their balance sheet is actual value of debt. Sometimes, if we try to calculate it more precisely, the market value of debt could be other than the value presented in the balance sheet, but mostly it was the case. But with a private company, everything changes, because first, in most cases, we don't know the market value of equity. They are not traded. So we don't have market value. We don't have market price for their shares. Yes, they have shares, but those shares don't have market price. And the same happens with their debt, actually. We can see their obligations on their balance sheet, but it takes some effort to see the real nature of those obligations. Sometimes we can see a debt, but actually, in fact, that's not debt, because, for example, this is obligation to shareholder, and that means that just a shareholder invested some money, structuring it as a loan, for example, but the company, in fact, doesn't own all this money to the shareholder. So things like that happen with private companies a lot. And another problem is that even beta, how can we calculate beta for a private company? We calculated betas for public companies based on changes in their share prices. We compared fluctuations of their share prices to the market index, but here we don't have it. Yes, we still can apply industrial industry beta taken from sources like the Mondragon. But this is a question, to what extent we can apply a beta calculated for public companies to a private company, because the private company doesn't have these changes in the market value or in the market price of its shares. It actually doesn't have any such a thing as changes in the market price of shares. We can have different valuations in different times, but there's no market price. And because of that, we'll be having a problem with calculating just discount rate for us. Look at this example. Here is the company, and this is its balance sheet. This is a private company. Look at that and try to calculate its weighted average cost of capital. For this example, we have required return on equity 20%, cost of debt is 12%, and there's no income tax. Just look at that and post your answer to the chat. What is the discount rate? Any idea? 16. I don't think so. No, tax rate is 0 for this example. Tax rate is 0. $12.7 looks more plausible because let's look at this. Where is our equity? First, it's owner's equity here plus retained earnings, because the retained earnings is another part of equity. So this company has equity about 26,000 and debt is about 270,000. So it looks like its capital is 10% of equity and 90% of debt, roughly, right? So we take 10% of this, that's 2, plus 90% of this, that's well, 10, 10.8, yes, 10.8. So we get 12.8 as weighted average cost of capital. And it looks like it was quite a straightforward if this is the information we use. But what if now we go in to buy, or we just bought this company paying 270,000 for the company? That changes everything. If we just bought it for 270,000, that means that now it has 50% of equity because we valued this company at this level, and 50% of debt because it still has 270 of debt. And now our WACC is 50% of 20, that's 10, and 50% of 12, that's 6. So now WACC is not about 13, but about 16%. So the transaction based on our valuation changes our valuation, because the only source for the market value of the equity of this company is our valuation. So we have a circular dependency. This is the problem. And sometimes you can just do this calculation twice or 3 times, just to analyze the cost of equity you should use in your weighted average cost of capital. But in most cases, the way we use for this business is a bit easier. We do one of the followings. We either calculate just FCFE, so we can skip this step of calculating WACC and use just cost of equity, or we can calculate weighted average cost of capital based on actually in this case, yes, we should do this several times because we calculated based on expected value of equity. Okay, so the first problem was with absence of market values, and we'll see this problem again later when we'll be talking about discount rate. But the next problem, a very big problem, is the quality of financial statements. With public companies, we expect that sometimes some other things happen, but we can expect that the reporting standards and approaches used by the company are targeted to a fair disclosure of its performance, right? And the second thing is that we expect that with financial reports of a public company, we can see the whole business, one and the whole business. And with a private company, sometimes we just don't see the whole picture when we look at the financial reports. Look at some examples. For example, we have a private company, and the CEO of this company is paid $1.2 million as salary a year annually. But our estimation is that the market rate for the CEO of a company like this is $800,000. What should we do? Before we do our valuation, in our financial model, we should reduce administrative expenses by this excessive $400,000, right? Another example, we have a company, and this company leases a warehouse for the price $200,000 per year, but they leased it from a family member. So we understand that this rate is not a market rate, and the market rate for a lease like that is $300,000. What should we do again? We should increase our general expenses by this $100,000, because if we bought this company, it would pay $100,000 more. Another example, firms has a vacant building. This building generates expenses for operations and has some depreciation expenses. And this building isn't in use. What should we do? If we had this company, if we own this company, we would sell this building probably. So we should reduce our expenses by $90,000 for general expenses, depreciation with this $15,000, and that's questionable. Should we put in our forecast any revenue from sale? Because it's a bit risky. We're not sure, can we sell it or not? But we definitely want to exclude this asset from home company, from our business. Another thing, we go in to buy a firm, and we are a strategic investor, and we expect that when we combine our company and this another company, then our cost savings will be $230,000. And what should we do? If we are a strategic investor, then this cost savings will be our additional income. That's for sure, because we save that. If we are a financial investor, that's quite questionable. Mostly the answer is no. We don't account for this prospective synergy because we're not sure where these savings appear. maybe they will appear on financial reports of a buyer, of strategic buyer. For example, if I have a, I don't know, I have a supplier, and I'm going to buy this supplier. And when I buy this supplier, I expect that something like I don't know, maybe transport costs or just other expenses will be excluded, but where will be excluded those expenses? Maybe in my financial report, in my results, in my operations as a buyer of this supplier. But maybe the supplier will be more profitable because I will, for example, I will fire their management and will use my management team to manage this another business. In this case, these cost savings will appear as additional profit of this company, the target company, but this is not for sure. So for a strategic investor, all synergies should be included in valuation. For a financial investor, it's rarely the case. Okay, so the quality of financial reports is the second thing that spoils our life. The third, liquidity, and another thing, diversification. When we were discussing the return concept and discount rates, we introduced CAPM model. And in the CAPM model, one of the most important principles was that I have to be paid only for systematic risk, because any unsystematic risk I can diversify away. I will invest not in one company. I will buy shares of like 100 or 500 different companies. And in this bucket of 500 companies, any specific things happening with each company will be diversified by the same things that at the same time happen with all the other companies. And the only moment when I cannot diversify those risks is when they are correlated. So if something happens to those companies with relation to each other, or with some driver, some macro factor, in this case, I cannot diversify this risk. So I will ask for more return to cover this risk. But with a private company, theoretically, I can do the same, but the practice is different. When I buy a company, a private company, I usually buy one company, or maybe 2, 5. Some, I don't know, some people can own maybe 10 or more companies, but for most investors, buying a private company means owning just one company. And with one company, you cannot diversify any risk. And that means that the principle behind CAPM model just doesn't stand, right? And because of that, CAPM model doesn't work anymore. We can use the principle. We still can use the things we learned when we were learning CAPM, but we should change something. And the first thing we change in all our analysis, we use again the whole risk, not just beta, sigma instead of beta. We'll talk about that a bit later. Okay, so because of this one investment in one company, the risk, we take the whole risk of this company, and we take it for longer. We don't take it for till the next Monday if we want. We cannot buy and sell shares quickly. So because of that, again, the risk is higher. Yes, there's a specific risk for the company, unsystematic risk, but we cannot diversify it away. So we take this risk and we ask for some additional return in exchange. And generally, there's no I know specific proof or explanation for that, but just as some practice, you can think about 20 to 30% that we add as illiquidity discount for a private company. That means that if based on some public company parameters, we came to a value for a private company, then we should subtract 20 to 30% from this value because of illiquidity. Because with these illiquidity issues, we just have higher risk. And sometimes, in some moments, and that's another source of problems for us. Sometimes this illiquidity grows exactly in the moment when we going to sell the company, because why you can desire to sell the company? Maybe because you feel that things going badly for this business. But if the company is losing its value, that means that its liquidity will be even less, just because nobody wants to buy the company like this. And again, this is the difference with a public company. For a public company, in a good time or bad time, we, generally speaking, we can equally easily to buy it or sell it. Most public companies have quite decent liquidity as compared to a private company. With a private company, this is not about a share. This is about a business with all its advantages and disadvantages, with all its expectations, opportunities, and so on. And if you feel that, if you see that the company is losing opportunities, all the others probably see the same. So they just don't want to buy this company, and you can have this that asset as that weight that you cannot sell for any price. So the illiquidity should be accounted for as the discount, and you should understand that if things going badly, this illiquidity will be even lower than before. For illiquidity premium, just like with other premiums, we have two ways to include this premium in our valuation. You can either make your discount rate higher because of illiquidity, Usually people add things like 2-3% to the discount rate calculated for a public company, explaining that by this illiquidity premium. So because it's a private company, it must have discount rate 2-3% higher than for a public company. Or you can subtract your illiquidity premium from the value of the company. In this case, we apply public company discount rate or public company multiple in relative valuation, and then subtract this 20-30% from the final result. Okay, and because of this low diversification, as I said, if we believe that this business is risky, and this is a kind of non-systematic risk, so something specific for the business, in a public company, we would ignore this risk. For a private company, we would add this risk in our calculation. And because this specific risk can be pretty high, the discount rate based on this full risk profile can be quite high as well. And by the way, what do you think? What would be the discount rate for your valuation of a private company Okay, I'll answer that later. What do you think about the discount rate for a private company, a Russian company that currently have annual revenue, let's say 100 million rubles a year, and is starting a project that would drive its revenue to 2 billion rubles a year in 3 years. What do you think about expected discount rate for a company like this? Any suggestion? Okay, I would say the number like 30% would look quite reasonable. Why 30%? Because in the main scenario for this company, in our expectation, we expect that it's growing really fast. So it's a kind of venture project. We're going to grow 20 times in 3 years. So this is quite a bold plan. And with such a bold plan, the risk will be very high. And we cannot exclude any type of risk from our consideration. So we should ask something in exchange for this risk. And the question, this is a very fundamental question for any private company valuation task. Okay, we understand now that we should account for all risk. How do we measure it? Nobody knows, because private company doesn't have a very transparent history. Their future can be quite different from the past, and so on. So it's hard to measure risk. instead of measuring this risk, we usually just classify the situation we see for this company. Like in the example I just gave you. Why it's 30% for this company? Just because it has revenue, so it's not a very early stage startup. They have product, they have revenue. It looks like they're not at seed phase of venture investment, but 20 times in 3 years is pretty fast. So numbers between, I don't know, 30–40% is something quite regular for venture market for projects like this. We didn't calculate it. We just have statistics on what people apply to such projects. And unfortunately for private companies, even for much more simple projects, or just for working business, we don't have enough data to calculate our discount rate. We usually calculate discount rate for public company, and then we go somehow from a public company to this private company, and we'll discuss that now. We've discussed the issue with the key person, right? With those who can control the company even without owning it. So I'll skip that. And now let's go through valuation approaches, and we'll return to the issue of discount rate within this valuation. So we have two regular approaches to our valuation: income approach and market-based approach, or relative valuation. But with private companies, we have the third quite popular approach, asset-based valuation. I'll show you an example. So with income approach, what can we do? We can use either free cash flow valuation, just as we did it with a public company, and actually, in most cases, this is the approach people use. We can use capitalized cash flow valuation. In this case, we will split our cash flow into different streams and capitalize each stream. In this case, it would be like, we understand that this business has capitalized costs with value like 500 million rubles, and capitalized benefits like 700 million rubles. Why that? Because sometimes these cash flows come from different sources, and not all the cash flows for this business actually created within this legal entity. So it's like with an example of synergy costs. And the last possible approach is residual income or excess earnings. In this case, we take, instead of calculating expected cash flows of the company, we take its free cash flow, not free cash flow in this, it's not NOPLAT, net operating profit less adjusted taxes. So we take its NOPLAT, then we take the value of all assets used by this company, and we calculate the cost of owning assets like this. For example, I have intellectual property with value 1 billion rubles, and I have plant and equipment with value another 1 billion rubles. So I have assets with a value 2 billion rubles. And I expect that weighted average cost of capital for this company is 10%. So those assets have economical cost of 200 million rubles, 10% of this 2 billion. And then I take my net profit minus this 200 million rubles, and that's my residual income. Or you can use the term EVA, economical value added. The difference between the terms residual income and economical value added is very simple. Economical value added is a trademark. This is a trademark used for residual income. The term residual income used just to get rid of this usage of the trademark. So it's EVA. And capitalized EVA, called market value added, is the valuation for the company. So we can use this residual income approach, but I think that the residual income approach you should know only for the exam, for the CFA exam. You don't use residual income as is in your valuation models. Instead, and you'll see that in our case, instead we use free cash flow, but in this free cash flow approach, we use normalized capital expenditure, and this normalized capital expenditure, in fact, recreate somehow the residual income approach. So mostly is free cash flow, and this is just a regular free cash flow. We can use free cash flow to the firm, or we can use free cash flow. Or we can use free cash flow to equity. Free cash flow to equity helps us to forget about cost of equity and debt in the capital structure, but free cash flow to the firm in many cases are more convenient when we buy the company, because we go into attract debt to finance this acquisition. And this is an important thing for us to calculate the cost of debt and to calculate how much can we use from the company's cash flows to repay for this debt and for other capital. And free cash flow to equity in this case isn't that important for us, because the current equity and the current cost of debt will be, in fact, replaced by the new structure when we acquire the company. So for acquisitions, sometimes free cash flow to the firm is better than FCFE. So the discount rate. To use any kind of income-based valuation, we need the discount rate. And the difference between the discount rate and the discount rate for a public company is, first, our type of risk, the fact that we use the whole risk instead of just systematic risk. Another, we can use size premiums. Why we use size premiums? Because if I calculated my discount rate for a public company or for public market, then I should take into account that this public market consists of large companies. Those large companies are stable. They are more predictable. I have less risk with those companies. But with a smaller company, I have more unpredictable future cash flows. I have more risk, and because of that, the cost of equity should be higher, right? Another thing, if I used weighted average cost of capital for calculation, and I created this WACC for public company, then I should take into account that the cost of debt is higher for a private company than for a public company. Again, because of what? Because of the size, because of transparency, because of all those risks. Mostly it's size, transparency, some specific issues like this. Because for a bank, things like diversification don't work. So it's not about diversification, it's about size and about riskier business. Okay, so size premium, other cost of debt, and then we can use several models. Look, first, we can still apply CAPM model to a private company. In this case, we should construct, I would say, in this case, it's not calculatable. We should construct our beta somehow. So we mostly declare some beta for a private company, but all the other will be just as with a public company. We start with a risk-free rate, then we calculate equity risk premium for a public market and apply beta to this, but the beta will be different. Then we can go deeper and add something to our CAPM model. Then we start with risk-free rate, then we calculate a public market discount rate, a public market cost of equity, and then we add something to the company. We can add small stock premium, and we can add some company-specific premium. So for small stock premium, we usually add something like 2-3%, just like with liquidity, by the way. We can add 2-3% for illiquidity, then 2-3% for the fact that this is a smaller company than those public companies. And then the last step, we can add something specific for this company because we see some specific risk, some riskier situation for this company. And for what will we get with things like that? We can start with a public company in some, I don't know, maybe it's manufacturing company, a public manufacturing company, and we'll get something like 12% for Russia now, for large public company. Then we add 2% or 3% for the fact that our company is smaller, and we get the basic level of discount rate for a private company. It's 15% for mature private company with no significant growth plans. So it looks like a stable business. If that's the case, then we use this 15%. If, for example, the company is going to grow, and in our financial model, we put this high growth rate, then we can see that this company has higher risk, and we can add something like 3% more or 5% more because of those bold plans. And we get something like 20% for a private company. And we can build the same thing, not starting with CAPM, but using build-up approach. In build-up approach, we do basically the same. The only difference is that we don't mess with beta. We start with risk-free plus equity risk premium plus what we calculated as small stock premium on public market, or on such public market as in the United States, for example. We can calculate small stock premium based on public market. But in Russia, we just don't have the breadth of market such that we can calculate small stock premium. We are all small stock here. Then we add maybe industry risk premium, company-specific risk premium. In build-up approach, we don't have any fixed list of premiums, so you can choose whatever premium you like and add them. But basically, you have to come to something like this. For a private company here in Russia now, if this is quite a big company, big, mature, and stable company, your discount rate would be about 15%. For a company with growth plans, for a smaller company, small company is less than 1 billion rubles a year. For a smaller company, your discount rate would be maybe about 20%, and higher than 20% go some risky projects, like venture capital or new project finance ideas and so on. So basically, it's between 15 and 20% for most companies. Let's give the example. And with relative valuation, the principle is the same. We use information from the principles, the math from public company valuation, but we have to solve somehow our problems with the data. And with the data, the calculations of multiples are the same. So the only issue is comparables. We have three possible ways to calculate, to find our comparables. First, guideline public company. So we just find a public company or some public companies that are the same as our company and calculate multiples for them. Second is guideline transactions. Guideline transactions sometimes look better than the public company because a public company it has all those problems I listed. It's too big, it's too liquid, too mature, too transparent. We don't have it all in our private company. But if we have private transactions with other companies, when we can collect information about mergers and acquisitions on our market with companies like our company and so on, then for those transactions, the drivers behind value of those companies are the same. All drivers and restrictions are the same as for our company because they are private as well. And of course, the main issue here is that information about private transactions isn't that available as for public companies. We know them mostly when, for example, a buyer is a public company, and this public company disclosed the parameters for the transaction, or sometimes it happened because of other various reasons. So it's possible but it's not that readily available as for public companies. And another possible approach is prior transaction method. Prior transaction means that if our company was bought or sold before, and we know the multiples used in those transactions in the past, then we can apply the same multiples to our current performance, to our current revenue and other financial results, and just recalculate the value of the company based on its current performance. So these are three approaches for the market-based valuation. I'll skip this description. And just as with the income approach, with market-based approach, we have to add some premiums and discounts to this valuation. But the difference here is that if for the income-based approach, we had a choice between two possible ways to apply discount. We could apply this discount to the discount rate as the premium, add something to the discount rate, or we could apply it to the value. But with relative valuation, we always subtract something from the value. Or actually we can subtract some share of the multiple. So we can use it this way. But we will not add something to some discount rate that we doesn't have in this case. Okay, so what valuation discounts we have? Usually it's three types of discounts. First is size discount, just as we had size premium for the discount rate in our income-based valuation, and it's like 20–30%, as I said. Second is lack of marketability discount or illiquidity discount, and again, it's about 20–30% for a private company as compared to a public company, but of course it depends on the extent of this lack of marketability. Sorry. And the third possible discount is lack of control discount. So if we buy less than controlling share of the company, we understand that the major shareholder can manage this company in their own interests, not in ours. And because of that, the value of the company will be less than for a public company or for full control for the company. So when we value a public company, we value it the same way as 100% control of a private company. And the last possible approach, the approach that we didn't use with public companies, asset-based approach. Sometimes it's so hard to reconstruct financial performance of the company and to come to a forecast that's equally accepted by the seller and by the buyer. So it's just impossible to negotiate any price for the deal. And in those cases, for some types of businesses, another possible approach is just to buy and sell the company just like as a bunch of assets, not as a business, just as assets. And for example, the case that we'll be discussing now, this is a bus company. Bus company, I excluded this part from the case, but this bus company actually consisted of two parts. First is buses. It's 250 buses. And the second is the base. The base where they have repair workshops, parking lots, and so on. So one of possible approaches to value this company was forget about its revenues, costs, everything. Just think about this company as this list of assets. If you go in to buy it, if you don't believe that the current owner manages this business efficiently, that if you believe that you can manage this properly, okay, you want to enter this business, well, just buy these assets. And sometimes it works. Sometimes it works better just to calculate the value as the value of those assets. So this is the last possible approach for a private company. And now, before we go into it for a break, I'll show you what we'll be discussing after the break. And because of this task, we'll make our break a bit longer, so you'll have some time for a real break, and then you'll have time to work with the model. So what is the case? This is a real case. All the numbers are fake, but the case is quite real. So I won't tell you the city and the company, but that was a company that still operates, actually, that operates municipal transportation. So this is a city bus company. This company operates 250 buses, and last year it was, or it wasn't, but at least there were negotiations about buying this company. And the background for this company is the following: the owner of the company has a conflict with regional government, and because of that, they didn't allow him to raise the fare. So tickets are very cheap in this city, bus tickets. That's good for the residents, but that's not good for the company. And this is the main problem for the company. This is because this is the reason why he decided to sell the company, because he believed that this is the only way to stop this conflict. A new buyer thinks that he can raise the price. Today it's 20 rubles. He thought about like 25 rubles. So he believes that he can negotiate this price with the government because this is regulated. And with 25 rubles, that will be adjusted for inflation each year. That looks a bit better. Now, this company owns all 250 buses, but the problem is that they didn't buy any bus for the last 6 years. So all buses are old, and they have to be replaced in the next 1 or 2 or 3 years. For the new buses, the new owner expects that they will be using leasing payments for those bosses, but those payments are not on the balance on the income statement of this company right now. And so this is the first issue or second issue. Yeah, the first issue is the FAB. The second is the bosses that should be replaced. The third, this company didn't distribute profits. Instead, the company hires personnel, not directly, but via an outstaffing company. And this outstaffing company has about 500 million rubles. 100 million rubles is the profit of this outstaffing company. And this is actually a way to distribute money from this business to the shareholder. So we should take this into account. And the company has some debt, but if we buy the company, the first thing we should do, we should repay its debt and replace it with our money. No matter what is the source of this money, it can be new debt or equity, anyway. And here is the model. We have this link. Again, I'll post it one more time here. Or you can find the model on your LMS. So you can open the model, look at it. We'll have the break not for 10 minutes as we did before, not for 20 minutes. And after 20 minutes, if anybody volunteer to show me the model with your changes for your expectations, and to answer with this model the question in the presentation. So it's 2 questions. Again, one second. Right. So the questions are, how much will you pay for this company if you agree to buy it for any price? And how would you offer the deal to the seller? Can you structure the deal somehow so that it would make it less riskier for you? And if you answer the first question correctly, you get 10% to your final mark. So there's a reason for you to volunteer if you believe you can offer something. And you, by the way, have no risk in this case. If you answer incorrectly, you just don't have anything from that. So it's about 8 now. Let's make it to 8:22, and on 8:22, I'm waiting for your ideas, and we'll be discussing this model and how we actually value companies like that and structure deals like that. And for now, we have a break. So I'm here. Does anybody want to discuss the case and present your opinion? Nobody? Dmitry, have you updated the model? Can you show the model and explain your calculations? Hey, Victor, 8 billion rubles. Nice.
Good evening. Yes, I have this value
Okay.
because I add some information about.
Anybody wants to present the model? Nobody. Okay. We'll discuss your error in the next section of today's lecture. But I mean, the error you made by refusing to present the model. Well, let me open my model. So this is where we all started. And let's do all necessary adjustments to this model before we discuss it. So the first question, the model is pretty simple. I made it very simplified just to make the discussion easier. The volume grows. We have 70 million trips for 2020. And in 2020, this company lost 20% due to COVID restrictions, of course. And from one side, we expect that after those restrictions were eased, were raised, the volume should go high. But at the same time, we can see that historically, this bus company was losing traffic or losing passenger traffic with the rate 3% per year. So probably the passenger traffic for this company will not grow 20% next year. And by the way, that was at the second part of 2020. So we didn't know anything about 2021 by that time. So we couldn't expect that the passenger traffic will grow 20% immediately in 2021. Maybe something like 10%. And after that, we don't expect any additional growth because of this losing traffic that we expect to be the same as before. So we start with the company as is without any change, and I'll explain why. Next, the basic ticket price. They have like month's ticket, they have some subsidized tickets and other things, but this basic ticket price is close to what they get on average because subsidized tickets just paid to this price. And I just again simplified the model. So this is just trips and the ticket. As I said, until this company is owned by that guy, he will not get the raise in the price. So the price will be the same, 20 rubles, just because of his relationships with the government. Okay, now no changes, special changes in fuel. It just growing with inflation rate. Salary, it's 500 million now, but we remember that of this 500 million, 100 million is actually profit distribution. So we change it to 400. Other expenses are the same, they just growing with inflation. We got profit before tax. This company even looks profitable for now with this traffic. And then if we buy the company, we will have to repay the debt. So that creates negative cash flow. The discount rate, let's make it 20% for a company like this. This is a mature company with stable business, no special bold plans, just their plan is to stay the same. So between 15 and 20% because they're not too big. Let's make it 20%, and because we want to buy it cheaper. So what we have now, it's minus 140 million for this 7 years period. And why it's 7 years? Because 7 years is roughly the life period for a bus. We can operate a bus for 10 years, not more than 10 years. But when we present projects with buses, cars, with transport, we usually forecast it for 7 years because this 7 years is a normal life cycle for vehicles. Then we have 4% of long-term growth, but the problem is that in the last year of this period, we have negative free cash flow. So we don't expect any additional value. The terminal value is negative actually. So the final value of this company is minus 240, but no, it's not 240, it's much less. Because now we should think about what do we operate. We have old buses. Those old buses have to be replaced, right? And we will have to pay for those buses. How much? To buy all new 250 buses, it's 250. We will have to pay 9 million, it's here, 9 million per bus. So we would have to pay 2 billion rubles. But of course, we will not do this this way. We will smooth these payments through the whole period life cycle of the bus. And we can now create the most conservative version of the model, where we just divide that by 10, the maximum life cycle for a bus, and use this number for each year. So that means actually that we will be gradually replacing those buses with 1/10 of the park each year. This is the most conservative forecast for us. And now we have exactly what we expected. Minus 1 billion rubles. And this is the starting position for our negotiations with the owner. So the starting position is the question: do you understand that your business is dead? You don't have any business. Look at this future of your business. You will just be burning cash each year until the moment that business collapses and ruin your image and your reputation. Because, you know, if you close a factory, a small private factory producing something that produced for very competitive market, nobody will cry. But if your municipal bus company go bankrupt, this is a huge issue for the city. This is a huge political issue, and people will not forget that. You will not have any business in this city ever. So this is a big problem. You cannot drive this business to bankruptcy. This is a serious issue. And the first negotiation position is that you don't have business. So maybe the easiest way to have a deal if we just take this business for free. Why not? We actually, this is a gift from us if we take this business for free. But of course, people are not that silly, and he will not give it us for free, right? And his position in this negotiation was like that. Okay, I don't have this business in this city. Yes, this company just will hit the wall in a year, and this is dying business. Yes, but you don't have a business in the city either, and you want it. You want to enter this market, and you cannot create a company like this from scratch in a new city with new company, new car parts, and everything. You cannot do that either. So we need each other. And what I can answer to your position is that, yes, I don't have a business, but I have 250 buses. A new bus has price 9 billion rubles, or not 9 million rubles, and you would need more than 2 billion rubles just to invest in buses. You don't have this money, I believe. So you need my park of vehicles, and even an old bus has some value. An old bus like mine has average value of 2 million rubles. And with 2 million rubles and 250 buses, I believe that my business has value 500 million rubles. That was his position. Now, how negotiations went further? Well, what do we get if we enter this market? First, we can change the price for the ticket to 25 rubles. And the next years, it will be updated each year by the inflation rate. So we expect that our fair price, or fair, will be like this. Okay, we expect that we can negotiate this contract between the city and the company, but we're not sure. So, but if we successful in that, what do we get? Well, we get valuation at 800 million. So if everything's okay, that means that the value of 500 million rubles is good enough for us, right? But this is a risky investment. And with a risky investment like this, we would like to do something to make it more profitable for us. So our offer to the current shareholder is the following. Well, we're ready to buy not 100% of the company, but 50% of the company for 250 million rubles. So the first payment for us is 250 million rubles. Then we'll try to change the price for the ticket price, and we quite sure that we can do that, and we will pay for the other 50% of the company, not immediately, but we will give you all 100% of the profit for this company until the moment you get 250 million rubles. That means that in this year we pay all the money, and here from this profit we pay the next 70 million. Oh, next 90 million, right? Sorry, 110. 110. So the contract is not to buy the company immediately, but to buy 50% of the company and to sign a contract to buy the next 50% of the company. And for the second 50% of the company, we will pay you anyway. Even if something happens to the company, even if the company will not get any profit, we will pay you anyway, and we will set the minimum schedule for this payment to the level 150 million. So we will have to pay you all the profit this company earns until the moment we'll repay all 250, but not less than this amount. So this is not an option. We will have to pay you 500 million rubles, but with this schedule. So what's the difference? What it changes for this deal? It changes two things. First, the price Did we pay? Did we value this company for 500 million? No. We don't pay 500 million for this business. Yes, technically, nominally, it's 500 million, but let's calculate it actual price we pay. And for that, we need the discount index. For the first payment, it's 1, so no discount. And then it's the payment times our discount index. No, I won't use this discount index because this discount index is based on the middle of the year point. So I will calculate mine discount index. It's on the full year version. It's 1, then it's 1 over the discount rate plus 1. And the dividends are paid in a year from now, so it's the full year, not for the middle of the year. And the basic value I used in this deal is 461 million, not 500 million. But I understand that this value will be, this money will be paid only if I have the profit necessary for this payment. But if I take it as an obligation, and just only for obligations, I will have to discount them with full discount index. If I have them as obligation, then my cash flow is, this is the same, and this is my minimum payments. And with those minimum payments, I have actually 400 million. Instead of 500, I in fact paid 400. So this is the way deals in private equity structured very often because of two things. First, we can manage all our risks. Here, I take too much risks for myself. I understand that I will have to invest in all those new bosses. I have all these questionable things about new ticket price and so on. So I'm afraid to go to this market and to this company. But I wouldn't put a high discount rate because discount rate would scare the seller. He wouldn't agree to a high discount rate. So instead of this high discount rate, I structure the deal so that it lasts for several years. And during those several years, we distributed our risks, additionally distributed our risks, and that created this this valuation. And you can see that actually, to get 400 million, what should be my discount rate? It should be about 40, no? No, not 40. It should be about 35%. So I enter this deal with my expected discount rate about 35%, with taking all those risks. So for me, it's a venture project, but the seller expected that I would value this company just as a normal business without all those venture-like risks. So I valued this company at 20% discount rate, but instead of buying it for 800 million, I valued it at 500, taking into account his standpoint where the company has no value at all. And then I reduced the price further by this structuring. And I did another thing. Another thing is the key person issue. For a company like this, the CEO of the company is a very important person for this business, for its normal operations. So it's hard for me just to buy this company and take it and start operations without any problem. So by this gradual transition, I made my seller to stay in the business for 3 more years. And those 3 more years is a period for which the real transfer of all operations and powers in this business will happen. So this is how I would value this business and how I would structure the deal. And we can see from this example 2 important things. First thing is that for a private company, the value isn't something that just one sum. The value of the deal is linked to the structure of the deal, and it depends on the structure of the deal a lot. And the second thing is that you could see with this company that for one person it had no value, for another investor it has some value, depending on the relationship between the seller and the buyer. The value could be different as well. And this is another thing. All the lectures before, we analyzed the business as something, and the transaction, when we buy a share or a business, we analyze them as something that happens only once. And now we have to discuss another case where it actually happens not once. 1 second. And the last thing in our course is just a quick review of the idea of real options. You know what option is for a financial market? You have an option to buy shares, for example. The question was how assume terminal growth rate. In that case, the terminal growth rate, it's very simple. We assumed some forecasted inflation for the whole model, and this inflation rate was the only factor in our growth rate. So it was 0 real growth, just because that's not the full truth about business like that. But if you have a city with, I don't know, 1 million people or 500,000 people, and in this city there's 20 bus routes, and those 20 bus routes existed for last dozens of years, So we just expect that the company that operates buses in this city will walk on the same routes with the same population, and everything is the same. Yes, we can go deeper. We can think about changes in population. We can think about changes in their habits. That was actually the problem for the company, because for the last 10 years, this company was losing traffic because of changing in people's habits. More people used taxis. More people used private cars, and the company lost maybe about 15% or more of its traffic for the last 5, 6, 7 years. That definitely looks like a problem. But the new owner, that they discussed it with the seller, with the old guy, and they decided that they can stop it. Stop it the same way as people do that in many cities, because too much of private transport for a medium, even for medium size, and especially for large size cities, is a big problem. So the city authorities in many cities introduce rules, laws, some restrictions to force people from private cars to public transport. And the principles for that are quite ready. And in that city, they didn't apply those principles just because of that conflict, just because they couldn't cooperate with the city authorities. And the idea is okay to do that, just because that's beneficial for the city to have less private cars in the center, especially in the center of the city. So the terminal growth here was just inflation with no real growth, with no real loss of traffic, and like a stable business. Okay, let's come to the real options. So with a financial asset like a share, the option is a contract that gives you ability but not obligation to buy or sell this asset, right? But sometimes things exactly like options could exist in real life. And let's have an example. Imagine a company. This company has the opportunity to build a new power plant. And to build this power plant, they have to invest 1.1 billion rubles. Their required return is 10%. In the first year of operation, they expect that free cash flow from this project will be $100 million. But from the second year of this project, the government will implement a new smart grid project that will affect net cash flows of this project, of this power plant. And we don't know, will this smart grid project go well or not that good? And we expect, just for simple calculation now, we expect that there's 50% probability that this project will go well for each of 2 phases. If the first phase or the first year of the project, our next year, or our second year, goes badly, then demand for our power plant go down and we lose 20% of our free cash flow. So we get $80 million. If it's okay, then we get 25% more and we got $125 million. And the same will be for the next stage of this project. If it's okay, we get 25% more. If not, we get 20% less. And then we stabilize at the level we get by that time. So generally, we have the following three of opportunities. We have 100 million for the first year. That's well, 1 second. We have 100 million here, that's for sure. Then we have 50% probability to get 125 and 50% probability to get 80. So on average, expected cash flow for the second year is 102 million. And then from the good node, we can get to 156, or we can go down back to 100. And from the bad node, we can go up to 100 or down further to 64. So the average expected cash flow here is 105. This is exactly how we would do that with a public company. We would forecast possible outcomes for this company, calculate expected outcomes. Later, we could analyze risks of going up and down. That would be our sigma. Maybe we would change that sigma in our analysis to beta, but those are our risks anyway. And in the middle of that, our expected cash flow. So now we can analyze these expected cash flows. We start with 100 discounted with 10%, then the second year, the third year plus 105 divided by 10%, that's our terminal value. So we get that all future cash flows of this project has net present value equal to minus 57. It's of course it's we add minus our initial investments here, right? Minus our initial investments. So the net present value of this project is minus 57, means no go. We don't invest in this project because it's just unprofitable for us, or its profit is much less than our expected profit, expected return on our investments, right? This is how we do that with a public company, with company that we cannot manage, the company where we cannot change our behavior or behavior of the company. But what if, wait, what if we can delay for 1 year? Maybe we should pay something, but we will not start the whole project right now. Maybe we'll buy land plot or buy a license or start some preparations, invest something so that we will have this opportunity to invest in that. But we will just skip the first year. We will not operate in year 1. Okay? And after this first year, we will know what happens to this project, to this smart grid project. After year one, we are either in the upstate, the project goes is going okay so far. So the first stage is okay, or we are in the down phase, in down state, right? The project went bad for the first stage, so maybe it will be better in the stage 2, but so far it's not good. In the upstate, we have expected cash flows 150, and then our cash flows are either 150, 125, and then it's 156 or just 100. So the expected cash flows are like that: 125, 128. And for the downstate, the expected cash flows are like that: 80 and 82. For the upstate, our present value is the question. Yes, for now, we assume that the probabilities are stable, just to make a very simple calculation. In real life, of course, it's more complicated. So for upstate, we have present value for this project about 1.3 billion rubles. So minus 1.1 rubles, not rubles, dollars. So when we subtract our initial investment of 1.1 billion, we get positive net present value. And for the downstate, yes, we have negative present value, because present value of future revenues is 800 million, and minus 1.1 gives us negative present value. But we haven't started the whole project yet. So if we see that the smart grid isn't okay, it went bad, and we have this negative value ahead, which has just one goal. So we want to go into this project, and instead of negative net present value, we got 0. So we have a choice now with 50%, because the second stage has still this 50% of probability for the upstate and downstate. With 50% probability, we get 177, and with 50% probability, we have 0. We discount it, and we get 80, right? So now, what do you see from these calculations? First, the value of real option to delay the project for 1 year is the difference between net present value of our first version, when we didn't wait, we just invested, and the second version, when we waited for 1 year and only then we invested. So this difference is $130 million. This is the value of this real option. And because of that, this project now, even with the discount, because this new investment is a year from now, it has net present value $73 million. This is some excessive profit. It's on top of what we expected and what we calculated for with our discounting. So what we can see from that is that we are ready to pay now up to $73 million only to wait for the beginning of wait for 1 year before we invest the whole sum, or we can invest up to $1,173 million instead of 1.1 billion to invest a year from now. So we could make it profitable. We just have to find a way for the price not more than $73 million, wait for 1 year and still keep our right to invest in this project. This is the idea. So the main thing here is that in all our valuation, in all our models, we always expect that when we take risks, we take all the risks. If any parameter of our project, if any outcome, any scenario for our project drives us to losses, we take the whole loss just as we take the whole profit. This is the case when we buy a share of a public company and we don't manage anything. We just we invested in this share and we take all the risks this company has. But this is not the case with a private company, where we actually always, any day, any year, we always have choices. And because of that, for many projects, we don't have to accept the losses. We can stop the projects before we get all the loss from unsuccessful scenarios. But we still can get all the profit from successful scenarios. And this is a very important principle behind valuation of private companies. We can create this base case scenario, value a company, and think about what we get from this scenario, plus minus all our risks. But then our scenario analysis can be much more sophisticated. We can analyze good and bad scenarios, and we can stop getting losses from bad scenarios and get profit from good scenarios. So final valuation of a private company in many cases is much higher because of that, because we can avoid risks, avoid losses. And the options like that, they exist in many versions. I will just list some kinds of options that you can see in businesses. So we just discussed an option to delay, right? We can spend some money to buy a license, to buy land, to buy technology, to start negotiations, and so on. But wait before we invest the full sum. And with this initial investment, we buy an opportunity to invest or not to invest when the times come. Another version of that is staged investment. And with staged investment, the idea is it's like the option to delay. Instead of buying or building a big factory, for example, we can invest in a land plot for big factory, invest in some infrastructure for a big factory, but then not to invest in the whole capacity, buy just equipment for 1/4, for example, of the whole factory. By this way, we invested less than for bigger factory, but yes, for example, we thought about a cement plant with capacity 1 million tons a year, but instead of investing in plant like this, we bought a land plot, we invested in infrastructure, but build a much smaller plant with capacity 200 tons, 1,000 tons a year. It looks like we paid more than we needed because we bought more land that we need. We invested more in the infrastructure that we needed for this size of the plant. But this investment is a real option. With this land infrastructure, we bought an option to expand. And this is actually another term for options: staged investment or options to expand, options for future growth. Another possible option is an option to alter operating scale. For example, I built a building, an apartment building. I can start selling all the apartments right now and sell them at the market price, at the prevailing market price at the moment when I finish the building. But if I don't have too much debt, that would force me, of course, to sell my apartments as fast as I can. But if I don't have too much debt in this project, and I see that market prices are unfavorable, they too low, I can wait. So I can stop or reduce my sales until the moment when I believe the prices go up. The same way I can do it with natural resources, with oil or gas or any other natural resources. I can change my production scale depending on the prices. So in the times of good prices, I will produce more. In bad times, I will produce less. So I will get less losses and more high profits on my amount of resources, right? Another option is an option to abandon. I can just stop the business. If I see that this business is unprofitable and will not give me any profit in the future, I can stop it now, before I got all the negative outcomes from this business. Just like this guy, his business is unprofitable now and he doesn't have any chance to get it, make it profitable. So he just sold it no matter at which price, but he didn't get any losses that would be generated by this business in this scenario, in the scenario where he's now, right? Another option is option to switch. Just option to change the type of production if this market just went bad. We can use the same equipment, we can use the same resources we have and just rearrange them to change the product or change the market or change whatever. So even if we have not very good expectations for the base scenario market in our project, maybe we can just switch the market if the future of the market went not favorable way, not our base scenario. right? And I mentioned growth option. So we have options like this, and they can be different, but they exist in most private companies. And this is we discussed before that. We discussed factors that make valuation of a private company usually less than the valuation of a similar public company. But this is a source of additional value, quite natural for a private company and not available in a public company usually. And that's because that's why people sometimes invest in private companies, even if the base case scenario, the basic model for the company doesn't show any good value in this business, just because they won't take losses and they take only only profits available from this company. Okay, so we've finished for today, and with that we actually finished the whole course. The last thing you have to do in this course is to finalize your home assignment. So I'm waiting for your models, for your reports. You still have time to discuss your drafts if you send it until I don't know, until the next Sunday, I believe. I'll try to answer so that you have time to change something if you need. And next Tuesday we'll have the exam, and that's all. So see you next Tuesday, and I'm waiting for your assignments. Bye-bye.